What if you could build a bank, but with no bankers? A stock market with no brokers? What if you could build a whole financial system with no borders at all? Well, that right there is the huge promise of decentralized finance, or DeFi. And today, we're going to break down exactly how this new world of money, built entirely on code, actually works. So here's our game plan. First up, we're going to see how the old world of money stacks up against this new world of code. Then, we'll open up the hood on the automated crypto bank. After that, we'll look at what happens when things go wrong in this, super volatile world. We'll also see how you can trade without ever needing a broker. And finally, we're going to do a reality check, separating the hype from what's really happening. All right, so to really get a handle on DeFi, we first need to talk about what it's replacing: traditional finance, or what people in the space call TradFi. Let's break down the key differences between the system we all use every day and this new one being built on the blockchain. And this table, this really lays it all out, doesn't it? On one hand, you have TradFi, kind of this closed system run by a few really powerful companies. On the other, you have DeFi, which is totally open and permissionless. And while TradFi does its business behind closed doors, DeFi is just radically transparent. Every single transaction is out there on a public ledger for anyone to see. Just think about it. Ever tried to open a bank account in a new country? It can be a total nightmare of paperwork and approvals. With DeFi, all you need is an internet connection and a crypto wallet. That's it. There are no gatekeepers, no one to tell you no. It's a truly global system from day one. And this is where it gets really mind-bending. In the traditional system, you have to trust that the banks are being honest. In DeFi, you don't have to trust anyone. You can literally verify everything for yourself right on the public blockchain. It's a system built on this idea of don't trust, verify. Okay, so we've seen the big picture ideas. But how does this stuff actually work in the real world? Well, let's dive into one of its most powerful applications: a bank that runs completely on code, not people. So the engine behind this automated bank is something called a liquidity pool. Just think of it as a giant shared pot of digital money. It's all managed by a piece of code called a smart contract, which is basically a bank vault that runs itself based on a set of rules that can't be changed. So you want to be a lender? It's seriously this simple. You deposit your crypto into one of these pools and bam, you instantly become what's called a liquidity provider. The system automatically starts paying you interest based on real-time supply and demand. No paperwork, no meetings, no asking for permission. It just works. Okay, but wait a second. This brings up a huge problem, right? How in the world do you lend money to a complete stranger on the internet who has no credit score, no legal contract, nothing? It sounds like a recipe for getting completely ripped off. Well, DeFi's clever, if, not so perfect solution is this thing called over-collateralization. Basically, to get a loan, you have to put up collateral that's worth more than the loan itself. It's a way to protect lenders in a system where you can't trust anyone. But hang on to that thought, because it has massive implications for who can actually use this system. Right, but we're talking about crypto here. Volatility is the name of the game. So what happens when the market goes nuts and the value of your collateral starts to tank? Well, that's when DeFi's automated risk management system kicks into overdrive. Okay, let's walk through a real-world example. Imagine you need $1,000 for a new laptop. You don't want to sell your crypto because you think the price is going to go up. So instead, you take out a DeFi loan for $1,000 in a stablecoin, which is just a type of crypto designed to stay worth $1. So to get that $1,000, the system says, okay, but you need to post 150% collateral. So you go ahead and lock up $1,500 worth of your Ethereum to secure that loan. And what that does is create this $500 cushion. It's a buffer, right? If the price of your Ethereum dips a little, the people who lent you the money in the first place are still protected. They're safe. But if the price of Ethereum just falls off a cliff and that $500 buffer disappears, bam, the system's self-defense mode kicks in. It's called automated liquidation. The smart contract doesn't call you, it doesn't hesitate, it instantly sells your collateral, often at a discount, to pay back the loan. It's brutal, but it's what keeps the whole system from falling apart. Okay, so that's lending. Pretty wild, right? Now let's see how DeFi is taking on trading, with a whole new kind of exchange that operates with absolutely no central company in charge.
To get your head around this, I want you to picture a giant magical vending machine for crypto tokens. It's always on, it's always stocked, and it can give you pretty much any digital token you want, instantly. That's really the best way to think about how these decentralized exchanges work. So how does this vending machine work? Well, the machine itself is just one of those liquidity pools we talked about, but holding two different tokens. People like you and me are the ones who stock it. And when you want to trade, you just pop one token in and get another one out. The best part? The price isn't set by some big company. It's set by a simple math formula that's always balancing things out. So you're probably wondering, who's stocking this thing? The answer is, you are. Or you could be. By becoming a liquidity provider, or LP, you can deposit your own assets into these pools. And in return, you get to earn a piece of the trading fees from every single swap. You're not just a customer, you're actually helping to make the market. Automated banks, decentralized exchanges, finance for everybody. It all sounds amazing. Almost too amazing, right? So let's get real for a minute and talk about the risks and the actual reality of DeFi today. And this quote right here, it just hits the nail on the head. See, DeFi doesn't get rid of risk. It just moves it around. It takes that risk from the big banks and corporations and puts it right on your shoulders. Think about it. In the regular financial world, you've got safety nets. If your bank attacked, your deposits are usually insured. But in DeFi, you are your own bank. Which sounds cool, but it also means you are your own security guard. If you lose your password or a smart contract gets hacked, that money is just gone. Poof, forever. And what about that whole promise of banking the unbanked? Well, here's the paradox. The system that's supposed to help people without access to finance is built on a model that requires you to already have a bunch of capital to borrow anything. Remember that over-collateralization we talked about? Yeah. It kind of excludes the very people it claims it wants to help. So that leaves us with the big, multi-billion-dollar question. What is DeFi really going to be? Is it this revolutionary new financial system that's going to empower billions of people? Or is it just a faster, more complicated casino for people who are already rich with crypto? The tech is absolutely incredible, no doubt. But the final chapter? Well, that hasn't been written yet.